Imagine a company that acts like a rocket ship. The stock price climbs every month. Executives appear on magazine covers. Analysts call it the future. Employees feel lucky to work there. They pour their retirement savings into company stock. They believe they are part of something special. What happens when we find out that none of it is real? The profits are fake. The growth is a lie. The whole company is a giant house of cards. When it collapses, $74 billion vanish into thin air. This is the story of Enron. $74 billion. Enough to buy every home in a city the size of Miami. Enough to pay every public school teacher in America for a year. Enough to build 50 hospitals. It all disappeared. Not in a fire. Not in a flood. It disappeared because smart people decided to lie. So how does a company this big just vanish? The story starts simple. Enron began as a natural gas pipeline. Business? Nothing exciting. Just moving gas. But in the 1990s, a man named Jeffrey Skilling arrived with a big idea. Why sell gas the boring way? Trade it like stocks. Buy cheap, sell expensive. Pocket the difference. No one had done it before. Investors loved it. Money rolled in. Soon Enron traded everything. Electricity, broadband, weather futures. If you could price it, Enron traded it. The company grew so fast it made people dizzy. By 2000, it was the 7th largest company in America. Fortune named it the most innovative company 6 years in a row. 6 years. Stock hit $90 a share. Executives bought private jets. Employees thought they'd hit the lottery. But here's the thing. Enron was not making money. It was drowning in debt. Bad investments lost billions. The company was a sinking ship. Executives just painted smiles on everyone's faces and pretended everything was fine. How did they trick the whole world? 2 main tricks: secret shell companies and fake future money. Here is how the shell companies worked. Imagine you have a credit card bill you cannot pay. $30,000 and growing. You do not want anyone to know. So you hand that bill to your best friend and say, "Hold this." Then you tell everyone your credit card balance is 0. That is what Enron did. Except instead of a friend, they created fake companies with names like LJM and Raptor. They moved bad debts and failing investments into these fake companies. Then told investors, "Look at our clean balance sheet. No debt here. Everything is great." The man running this was Andrew Fastow, the chief financial officer. Here is where it gets dirty. Fastow did not just create these fake companies. He ran them himself. He was both CFO of Enron and secret boss of the companies hiding Enron's debt. The board of directors knew. They actually voted to let him do it. Made a special exception to their own ethics rules. Fastow made tens of millions in fees from these fake companies. He got rich while his company sank. The second trick was sneakier. Mark-to-market accounting. Sounds complicated. It is simple. Normal companies do business this way. You sign a 10-year deal to sell something. You make a little profit each year. That is honest. That is how money works. Enron did the opposite. Sign a 10-year deal. Guess how much total profit you will make over the entire decade. Then book every penny of that guessed profit on day one. Like getting paid for 10 years of work before doing a single day. This created fake profits out of thin air. But it also created a monster problem. Those guesses were often wrong. Sometimes catastrophically wrong. A project they thought would make $1 billion actually lost $200 million. Instead of admitting the mistake, Enron hid the loss, moved it into one of Fastow's secret shell companies and pretended it never happened. Then went out and found another deal to book more fake profits to cover the old fake profits. A treadmill moving faster and faster. Everyone on it just waiting to fall. At this point you are thinking, wait, wasn't someone supposed to catch this? Yes, Arthur Andersen. One of the biggest accounting firms in the world, 110 years in business, respected, trusted, paid millions to check Enron's books and make sure everything was honest. But here is the problem. Andersen was also paid millions in consulting fees. Enron was a golden goose. If Andersen blew the whistle, they would lose a client paying them $100 million a year. So they looked the other way. Signed off on the fake shell companies. Approved the fake accounting. Helped Enron fool everyone. Not everyone inside Enron was fooled. A woman named Sharon Watkins worked there as vice president. She saw the numbers. Knew something was terribly wrong. In August 2001, she wrote a memo to Kenneth Lay, the chairman. She said, "I am incredibly nervous that we will implode in a wave of accounting scandals." She handed him a map showing exactly where the bombs were buried. Kenneth Lay did nothing, ignored her warning, and went back to his corner office. A few weeks later, the bombs started going off. Enron announced a huge loss, then announced their financial statements could not be trusted. Stock price fell like a stone. $90, $50, $20, $10. Investors panicked and tried to sell. No buyers. Banks refused to lend. Trading partners refused to do business. By early December, it was over. Enron filed for bankruptcy. Largest bankruptcy in American history at the time. Here is the part that still makes people angry. While the company melted down, executives took care of themselves. Weeks before bankruptcy, Enron handed out $55 million in bonuses. 11 top executives got between $500,000 and $5 million each. They cashed their checks and walked away. Meanwhile, 25,000 ordinary employees lost their jobs. Their retirement accounts, stuffed with Enron stock they were told was safe, turned to zero. $2 billion in pensions. Gone. Just like that. Did anyone pay for this? Yes, but it took years. The FBI launched the biggest corporate fraud investigation in its history, the Enron Task Force. Agents filled warehouses with evidence, interviewed hundreds of people, built cases against more than 20 executives. Jeffrey Skilling, the CEO who created the whole trading machine, was convicted of conspiracy, fraud, and insider trading. He sold millions in stock while telling employees to keep buying. He got 24 years in prison, served 12. Got out in 2019. Kenneth Lay, the chairman who ignored Sharon Watkins' warning, was convicted on all charges. Died of a heart attack before sentencing. Andrew Fastow, the CFO who ran the secret shell companies, pleaded guilty and testified against his old bosses. Served about 6 years. Released in 2011. Here is what it did. First, CEOs and CFOs now personally sign their financial statements, cannot say the accountants messed up. They sign it. Their name goes on it. If it is a lie, they go to prison. Second, the law created a new watchdog called the Public Company Accounting Oversight Board. Could this happen again? Honest answer is, yes, frauds still happen, but the system is stronger now. Penalties are higher. Watchdogs are more alert. Memory of Enron still sits in the back of every CEO's mind. Every time a chief executive signs a financial report, they know what happened to Jeffrey Skilling. Every time an auditor sees something questionable, they remember what happened to Arthur Andersen. Sometimes fear works better than any law. There is another legacy of Enron not talked about enough. It changed how ordinary people think about investing. Before Enron, employees often believed company stock was the safest place for retirement money. Your employer is solid. They pay you every week. Of course their stock is safe. Enron proved that was a myth. Any company can fail. Any stock can go to zero. Never bet everything on one horse. That lesson cost $2 billion, but it stuck. The numbers in this story are almost too large to understand. But underneath all those zeros is a simple truth everyone should carry. When the numbers do not add up, it is usually because someone does not want them to. And the longer the lie lasts, the harder the fall will be. If this story surprised you or taught you something new, hit that like button. There are